With more and more investors now wary of equities given the recent volatility in markets, there is a growing number of alternative offerings. There are, at least, for people who want to put their money to work. And of course, ANZ and certainly Westpac, the latest, New South Wales at least, the latest to target the retail market with new issues. Mark Todd from FIG Securities in Sydney joining us now. Mark, in a sense, this offering of Waratah bonds from New South Wales is nothing new, although is it a variation on a theme? Tell me more.
I think, and good morning, Carson, in our mind, it's just the momentum into the retail market. It seems to us that the New South Wales Treasury, the T Corp, is looking to get investors to invest close to where, where institutional investors are. I think the rates are comparable to those institutional investors, and I think they're trying to tap what they believe to be an underlying demand for the retail market in terms of trying to get out of that volatility and look at consistent earnings in respect of the AAA credit that TCOR can provide. I mean, it's always been available, don't get me wrong. It's just the marketing process around it. They're bringing that to market. It's in all the papers, and they're making people aware of the opportunity.
What is the reward from that? Essentially, you park your money, a couple of $100,000 into a Waratah bond offering. What are you going to get at the other end of it?
I mean, I think the rates are, 3 years are about, there are 4. I've got it here, 4.25 and 5.10. I mean, don't get me wrong, Carson. We're not actually out here trying to say that the Waratah bond is the greatest thing that our investors can put their money into, and I hope Mike Bair's not watching. But if you are a very conservative investor and you are looking at the volatility that you've had in what was supposed to be a balanced portfolio, you might very well look at that and say, I have 200, I might just put 50 away and get some balance in that portfolio.
That's the thing, because you said rather there, ironically, it was supposed to be a balanced portfolio.
Oh, yeah.
The skew gives the lie to that. A 60-40 split on average into equities. Where's the balance there?
Yeah, I think it's a hard thing too. I think the idea has been that people have said that the equity salespeople have said this is balanced, and the effect has been that it wasn't balanced, or the behaviour hasn't been balanced. And I think at the moment we're seeing a decoupling between I want to talk to an equity salesperson, I want to talk to a debt salesperson, and with technology being what it is, I can look at my entire portfolio and say, well, that now feels more balanced.
Yeah, what's been the profile of those who are going down that road? Because today the Prime Minister said super is our sovereign wealth fund, and yet superannuitants have been given a hiding, to put it mildly.
And that's true, and I think if you look at sovereign wealth funds, they've copped a hiding as well, so I can understand her point. And I don't want to advocate one or the other. I think for our customers, in terms of that self-managed super fund, that sophisticated investor, if you've been into the debt markets over the last 3 years, you've had a pretty good performance. So, as credit, as an issue, as an investment opportunity, if you look at that, and we see that all the time, where, really nice yields are coming through in that 8 to 10%, on an underlying asset that you can understand, whether it be an investor, whether it be something specific to a development, a property development, you can look at that and say, I understand the cash flows and I understand the credit, and I'm prepared to take that 8% yield. So I think those self-managed, those sophisticated investors would be looking at credit saying it's performed pretty well.
Tell me about the ANZ offering. We just tipped off what New South Wales has launched, but $1.25 billion raised overnight. What was the purpose of that, and how does that augment people's understanding of what ANZ's core business is?
Sure. That's an interesting one, and that is the first under the potential new APRA guidelines around the Basel III, so it's a Tier 1 capital raising. And what it's done is given people a debt performance with close to an equity risk, certain reactions. So, in terms of that issue, it went well. I mean, it went from, they had 750, they got $1.25 billion. And that shows the strength of that equity sales piece, because that's equity sales people selling things that's listed on the ASX. They just want to sell stuff on the ASX. It's a fair return. I mean, I don't think it's in terms of its risk profile, it seems to be a reasonable return.
So as a bondholder, to understand it, if the unthinkable happened and the bank fell, where do you stand in getting that back?
So you're senior, you will take a haircut it's around the Tier 1 capital. So if it goes below 5%, I think it's 5.25%, you'll be asked to take equity at a discount. So you'll take a cut on your issue. It's not something anyone is really anticipating. I think when people analyse risk, they look at the nth degree, they cross every T and dot every I, which clearly they should do. You're at greater risk if you were to buy ANZ equity right now. Much greater risk.
It's interesting because you're talking about the need to balance portfolios, and we've pointed there to two instances, Mark, but it's got to go broader than that to really bring people in.
Oh, clearly.
And where are we at with being able to say across different sectors, this is fertile ground?
I think it is the chicken and egg question. So I think what you'll see is there's two things that'll happen. Basel III drives the banks who need to get away from international investors. They need to, our four pillars need to get more money from Julia Gillard superannuations. So they'll come up with different structures around debt to tap into that superannuant world. That has a self-professing to the corporates. That corporates will come and look to tap markets. They'll say, well, I might want to have a $50 million issue or a $100 million issue, and then come and tap it on a regular basis. Right. And we're seeing the evidence of that now. We're having corporates come to us and say, okay, what's the depth of that market? What's the distribution look like? And they're getting good results. So we're seeing people come to that market. Healthscope was a classic a few months ago. People come to that market now and are learning more about it. As it evolves, business has been pretty good for us, so as it evolves, we expect to see more of that happening.
All right, just clear out some of the red tape while you're at it, as they say,
Absolutely.
to get that process off the ground. Mark Todd from FIG, thank you so much.
Take care.
FIG Securities there with the very latest on that augmenting of your portfolio.